September 17, 2019. 8:47 a.m. Traders at the New York Federal Reserve stared at their screens in disbelief. The overnight repo rate, the interest rate banks charge each other for cash loans secured by Treasury bonds, had just spiked from 2.25% to 5.25% in a matter of hours. Some transactions hit 10%. This wasn't supposed to happen. The repo market had been the silent foundation of American finance for nearly a century. It moved $1 trillion every single day with the precision of atomic clockwork. But that morning, it broke. The Federal Reserve had no choice. They injected $53 billion into the market before noon. Then $75 billion the next day. Then another $75 billion. By October, they were pumping in hundreds of billions through emergency operations that looked suspiciously like the crisis interventions of 2008. And yet, if you search for news coverage from that week, you'll find almost nothing. No panic, no congressional hearings, no front-page warnings. Because the repo market, the most important financial market in the world, was designed to be invisible. Until it wasn't. Welcome to the Wealth Timeline, where we uncover how money, power, and history are woven together to shape the world we live in. Today, we're revealing the hidden architecture of modern finance, a century-old system of overnight lending that has become too critical to fail, too complex to regulate, and too fragile to ignore. The invisible foundation. Every night, while most of the world sleeps, approximately $4.5 trillion changes hands in the United States alone. Not in the stock market, not in cryptocurrency, not in anything you can follow on CNBC. It happens in the repurchase agreement market, the repo market, where financial institutions exchange cash for U.S. Treasury securities in transactions that last less than 24 hours. According to the Securities Industry and Financial Markets Association, the U.S. repo market averaged $4.6 trillion in daily outstanding volume as of 2023. Globally, the Bank for International Settlements estimates the figure exceeds $11 trillion daily. To understand scale, U.S. annual GDP is roughly $27 trillion. The repo market moves nearly 40% of that amount every week. This market finances everything. When you get a mortgage, when corporations issue bonds, when the government borrows money, when hedge funds make leveraged bets, the repo market provides the overnight cash that makes it all possible. It is the hydraulic fluid of capitalism. And for most of its history, it worked perfectly, quietly, invisibly. So what happened on September 17th, 2019, and why should you care about a market you've never heard of? Because if the repo market fails, everything else fails with it. The birth of overnight finance. The repo market was born from a simple problem in the early 1920s. Banks held enormous quantities of U.S. Treasury bonds, the safest assets in the world, but those bonds weren't liquid. If a bank needed cash for just one day, selling the bond and buying it back the next morning meant transaction costs, timing risks, and market exposure. In 1917, the Federal Reserve had just been established. By the early 1920s, New York banks pioneered a solution, the repurchase agreement. Here's how it worked. Bank A gives Bank B cash in exchange for Treasury bonds, with a legally binding agreement that Bank B will repurchase those bonds the next morning at a slightly higher price. That markup is the interest. It's essentially a collateralized loan that expires overnight. The beauty was its simplicity. The transaction was secured by U.S. government debt, the most trusted collateral on earth. Default was virtually impossible. And because it unwound every morning, risk was minimal. By 1923, the Federal Reserve itself began using repos as a tool for monetary policy. When they wanted to inject money into the banking system, they'd buy Treasury bonds with an agreement to sell them back later, a repo. When they wanted to drain liquidity, they'd do the opposite, a reverse repo. For decades, the market remained small, technical, and stable. It was the domain of commercial banks and the Federal Reserve. But then came August 15th, 1971. President Richard Nixon severed the dollar's link to gold, ending the Bretton Woods system. Suddenly, currency values floated freely. Interest rates became volatile. Inflation spiked. The financial world entered an era of radical uncertainty, and in that chaos, the repo market exploded. The rise of shadow banking. By the 1980s, the repo market had transformed from a niche banking tool into the central nervous system of global finance. Deregulation under the Reagan administration removed key barriers. The Glass-Steagall Act, which had separated commercial and investment banking since 1933, was gradually weakened. Investment banks like Goldman Sachs, Lehman Brothers, and Bear Stearns expanded aggressively into repo financing. They used it for leverage. Here's how. A hedge fund owns $100 million in treasury bonds. It posts those bonds as collateral in a repo transaction and receives $98 million in cash. The haircut protects the lender. The fund uses that cash to buy more treasuries, which it again posts as collateral, borrowing another $96 million. Repeat this process, and $100 million can generate $400 million or more in purchasing power. This practice, called rehypothecation, was legal, profitable, and dangerous. By 2007, according to the Federal Reserve Bank of New York, the U.S. repo market had grown to roughly $4.5 trillion in daily volume. Much of it flowed through shadow banks, institutions like money market funds, hedge funds, and investment banks that operated outside traditional regulatory oversight. The system depended entirely on confidence. As long as everyone believed their counterparty would repay the next morning, the machine hummed along flawlessly. But confidence is fragile, and in March 2008, it shattered. The repo run of 2008. Bear Stearns didn't collapse because it was insolvent. It collapsed because it ran out of cash. On March 10, 2008, Bear Stearns had $18 billion in cash reserves and over $300 billion in assets. But most of those assets were financed overnight through repo agreements. Every morning, Bear had to roll over billions in short-term debt. On March 11th, rumors spread that Bear was facing liquidity problems. By March 12th, repo lenders, scared of being left holding illiquid assets if Bear failed, refused to renew their agreements. This is the financial equivalent of a bank run, but in the shadows. Without access to overnight funding, Bear Stearns couldn't operate. By March 14th, the Federal Reserve orchestrated an emergency buyout by J.P. Morgan Chase for $2 per share, a company that had been worth $170 per share a year earlier. 6 months later, Lehman Brothers faced the same fate. On September 15, 2008, Lehman filed for bankruptcy after repo lenders refused to roll over $200 billion in overnight funding. The contagion spread instantly. Repo haircuts, the discount lenders demand as protection, spiked from 2% to 50% almost overnight. According to research by Yale economist Gary Gorton, this was the modern equivalent of the 1930s bank runs, except it happened in a market most Americans didn't know existed. AIG, Merrill Lynch, Morgan Stanley, all were brought to their knees, not by bad assets, but by frozen repo markets. The Federal Reserve responded with unprecedented force. They cut interest rates to zero. They created emergency lending facilities. They pumped trillions into the financial system through quantitative easing. And they fundamentally changed the role of the repo market forever, the new normal. After 2008, regulators promised reform. The Dodd-Frank Act of 2010 imposed stricter capital requirements on banks. Stress tests became mandatory. Leverage limits were tightened. But the repo market wasn't dismantled, it was institutionalized. The Federal Reserve established the Standing Repo Facility in 2021, essentially guaranteeing they would always provide liquidity if the market froze. They became the permanent backstop for overnight funding. This solved one problem, but created another. Moral hazard. If financial institutions know the Fed will always intervene, they have less incentive to manage risk carefully. They can use more leverage, take bigger bets, and rely on the central bank to catch them when they fall. And they did. According to Federal Reserve data, by 2019 the U.S. repo market had grown to $4.1 trillion in daily transactions. But new regulations meant that banks, despite holding $1.5 trillion in excess reserves, couldn't deploy that cash freely into the repo market without risking regulatory penalties. This created a dangerous mismatch. Demand for overnight cash was enormous, Supply was artificially constrained. And on September 17, 2019, that mismatch exploded. Two factors converged. Corporations withdrew $100 billion to pay quarterly taxes, and the U.S. Treasury auctioned $78 billion in new bonds, absorbing massive amounts of cash. Suddenly, the repo market needed liquidity, but banks couldn't provide it. Rates spiked to 10%. The Federal Reserve intervened immediately, with $53 billion in emergency repos. Over the following weeks, they injected over $400 billion. By October, they announced they would resume purchasing Treasury securities, what looked exactly like quantitative easing, though officials refused to call it that. The message was clear. The repo market was too important to fail, and the Fed would do whatever it took to keep it functioning. But this came at a cost. The invisible addiction. Today, the repo market is larger and more systemically important than ever. As of 2024, the Federal Reserve holds approximately $7 trillion in assets on its balance sheet, much of it acquired through repo-related operations during the 2008 crisis, the 2019 spike, and the COVID-19 pandemic response of 2020. That's nearly 25% of US GDP sitting on the Fed's books, and it can't easily exit. When the Fed tried to reduce its balance sheet in 2018, financial markets convulsed. When they tried again in 2022, Silicon Valley Bank and several regional banks collapsed, forcing another intervention. The problem is structural. The modern financial system has become dependent on abundant, cheap liquidity, provided through the repo market and backstopped by the Federal Reserve. According to the Bank for International Settlements, global debt, government, corporate, and household, now exceeds $300 trillion, more than 3 times global GDP. Much of that debt is refinanced daily through repo agreements. This creates systemic fragility. The collateral backing these transactions, U.S. Treasuries, mortgage bonds, corporate debt, is increasingly concentrated among a handful of institutions: BlackRock, Vanguard, J.P. Morgan Chase, State Street. If one falters, the contagion spreads instantly. And unlike 2008, where the problem was subprime mortgages, or 2019, where it was regulatory misalignment, the next shock could come from anywhere. A cyber attack, a sovereign default, a geopolitical crisis, a climate disaster. The repo market, by design, doesn't absorb shocks. It amplifies them. Which brings us back to the original question. Why did September 2019 disappear from public memory? Because acknowledging what happened would require admitting an uncomfortable truth. The most important financial market in the world is fundamentally unstable, impossibly complex, and too critical to allow to fail. So instead, we keep it invisible. We trust the Fed will always intervene. We assume the system will keep working, until one day, it doesn't. 3 things you must understand. First, the repo market is not a technical detail. It's the foundation of everything. It finances government borrowing, corporate debt, mortgage lending, and investment portfolios. Without it, modern capitalism as we know it would cease to function. It moves more money every week than most countries produce in a year. Second, central banks are no longer referees. They're players. The Federal Reserve has evolved from occasional market participant to permanent backstop. They guarantee liquidity, buy assets during stress, and signal they will prevent collapse at any cost. But this creates dependency. The system now requires constant intervention to survive. Third, history shows us that invisible systems are the most dangerous. The 2008 crisis wasn't caused by visible failures. It was caused by shadow banking, off-balance sheet vehicles, and overnight funding mechanisms the public didn't understand. The repo market today is larger, more interconnected, and more essential than it was in 2008. And we're trusting the same institutions that failed to see the last crisis to manage this one. The repo market was created to solve a simple problem: how to turn safe assets into overnight cash. Over a century, it became the invisible engine of global finance. But engines, no matter how powerful, require maintenance. They need transparency. They need limits. They need redundancy. And right now, we have a $12 trillion daily market operating in the shadows, backstopped by a central bank with a $7 trillion balance sheet. financing a $300 trillion global debt pile. That's not stability. That's a controlled detonation waiting for the wrong spark. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden chapter of financial history, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just rewrite what you thought you knew about power.